Forex explained in simple terms. If you're new to Forex trading, we'll take you through the basics of Forex pricing and placing your first Forex trades. Forex is short for foreign exchange, also known as FX or the currency market. It is the world's largest form of exchange, trading around $4 trillion every day. This exceptional liquidity ensures reliable pricing even at high volumes and enables the tightest possible dealing spreads. When you trade Forex, your trading costs are comparatively low and you can easily go long or short of any currency. The aim of Forex trading is simple. Just like any other form of speculation, you want to buy a currency at one price and sell it at higher price, or sell a currency at one price and buy it at a lower price in order to make a profit. Some confusion can arise as the price of one currency is always, of course, determined in another currency. For instance, the price of £1 could be measured as, say, $2 if the exchange rate between British pounds and United States dollars is 2 exactly. In Forex trading terms, this value for the British pound would be represented as a price of 2.0000 for the Forex pair British pounds United States dollar. Currencies are grouped into pairs to show the exchange rate between the two currencies. In other words, the price of the first currency and the second currency. Some commonly traded Forex pairs, known as major pairs, are Euros United States dollar, United States dollars JPY and Euros British pound, but it is also possible to trade many minor currencies, also known as exotics, such as the Mexican peso, the Polish zloty or the Norwegian krone. As these currencies are not so frequently traded, the market is less liquid, and so the trading spread may be wider. Why trade Forex? As Forex is traded on exchanges across the globe, from Tokyo to London to New York, you can take a position 24 hours a day throughout the trading week. Currency values are extremely sensitive to macroeconomic forces, so there are always trading opportunities. The trading app provides two different vehicles for trading Forex, spread betting and Cfds. Both of these products allow you to speculate on the movements of currency markets without making a physical trade, but they operate in slightly different ways. With spread betting, you stake a certain amount in your account currency per pip movement in the price of the Forex pair. So for instance, you might buy or sell £10 per pip on United States dollars JPY to make £10 for every pip the US dollar rises or falls against the Japanese yen. Forex traders have been using spread betting to capitalize on short-term movements for many years now. Find out more about spread betting. With CFDs, you buy or sell contracts representing a given size of trade. So you might decide to buy one contract of British pounds United States dollar, which represents a trade of £10,000. Your profit or loss is calculated in the second currency, in this case US dollars, and then converted, if necessary, into your account currency. Find out more about CFDs. Either way, you don't have to provide the full currency value to open your position. Instead, you put down a margin deposit, which is a fraction of the full value.